All right, everyone. So I'm going to cover springs today. And you obviously know why this is so important. Is because this is the setup. All right. So, yeah, but before I do that, I have to go over some stuff and recap. So give me a minute. So, we've already identified some of the steps that you need to take. The first is drawing the lines, right? So when you draw the lines, you're basically doing planning. All right. When you draw the lines, you're doing planning. Planning for what? Planning for trading. Why? Because that's where you're going to trade, against the lines. All right. So planning and drawing the lines is like planning, and then you're getting ready for the behaviors that you're looking for, which are what? The key ones, really the key ones that all you really need, to not make it complicated, is the test of the breakout and springs and up thrusts. That's about it. And this is what David traded, by the way. So, in fact, he liked springs and up thrust on the test of the breakout. So, long story short, draw the lines because you're basically planning. And what else that's really important is the lines. They have forecasting ability, meaning when you have this, chances are it's going to come back and test the line. And it's around this line, all right, that it's going to then continue. It might be on the line a little bit lower, sometimes a little bit higher, but it's around that line. So have forecasting capability of where the down leg will end, meaning where the pullback will end. That's why it's so important. The lines forecast where the pullback will end, with one caveat. All right, so this is what you need to know. When you have this, the line is really good. This line is really good. But when you look at the thrust from high to high, you have a lot of thrust. However, when you have this, right? This situation, the market will go to in this area. It will go below the line to like an internal higher high. So basically this is what happens. You have this, and then you have this, and this, and then that, right? So in this case, if you don't have that much thrust, it'll go back to an internal high and then continue. Very important. So it's not just that, it could be an internal high and not the rally high. The internal consolidation high instead of the rally high. So that's where it'll go to. Yes, if you don't find it here, it's going to go into that demand zone, right, that you all know about, order blocks, whatever. It's basically the green bar, the last red bar or the first green bar over here, all right, which itself is kind of like a range on a lower time frame. So very important to note that the key point that I'm trying to make is the amount of thrust indicates the amount of pullback, meaning the amount of thrust indicates whether the pullback is likely to tap the high, or if it's going to go lower to an internal high, here. And so you got to pay attention to not just the line, but other things, meaning the amount of thrust in the rally, the amount of follow through after the breakout. And that points me to another thing. You got to know where your breakout bar is. You have to be able to see and identify the breakout bar, especially when it has a good amount of follow through, because a lot of times the breakout bar, it holds the pullback. The pullback taps the breakout bar or goes in the breakout bar, holds, and then reverses higher. Happens all the time. All right, so someone, that breakout, whoever did the breakout is basically buying more at the breakout level. That's what's going on. All right. There was other thing that I wanted to mention, and you can verify this. You just look at the charts. The other thing is consolidations, right? Consolidations, they also have a structure. Consolidations or reaccumulations, whatever you want to call it, meaning after the market pulls back, it then moves, gets prepared for the next move. So the two things you need to understand that David had mentioned in his book that are so important is one about consolidations. That's so important about consolidations is one, the consolidation terminates or ends typically on springs and apexes. This is an extremely important point. Now, I want to take this idea and show you what you should be looking for. So when you analyze consolidations, right, there are three scenarios. Basically, I know it looks complicated, but they're just three scenarios. All right. The first scenario is rally, some pullback, and then it goes, and you get this move, right? So this is the break and test. It breaks out, has good fall through, retest, and then goes. This scenario is one leg pullback. So we call it one leg pullback. Meaning a pullback only has one wave or one down leg, right? Now you have more than one leg. And you can test me or check me on this, but go and see the market and see if this is what it does. The more than one leg pullback has two main types. The first is rally, pullback. Now the second pullback can either go lower than the first pullback and go, and this is what David's talking about. He says, they're resolved through springs. Right? Trading ranges being resolved through springs. So when you have more than one leg, the second leg is less than the first leg. All right. The next scenario is the second leg is higher than the first leg. Okay? So here, and obviously I'm talking about the lows, right? Meaning the low of the second leg is lower than the low of the first leg, getting into that ABC spring pattern. And the second scenario is it's higher. When it's higher, you can form a triangle. So we'll call this the apex. Where's the triangle? It's basically this. Okay? So you have when one leg, it comes back, pull back to test the breakout. And then the scenario B is when it pulls back and then retests. And that retest of that second leg its low is lower than the first leg, and it resolves the range. In this case, it's higher than the low, makes a higher low than the second leg. Excuse me, the second leg makes a higher low than the low of the first leg and goes. It's very simple. Either it goes lower or goes higher, and it resolves the range. Every other pullback is a variant of this. Every other pullback. Every single other pullback is a variant of this. And I'll prove this to you. Let's say you have this is more than one leg, so this I use 2 legs, right? If in the case that you have 3 legs, what happens? It goes down, hits the spring, hits the retest of the spring, and goes. So it makes a lower low and then makes a higher low. Lower low, higher low. So it's basically combination of the spring and the apex. You see? It makes the lower low spring and then the higher low apex. Hits the spring and apex. Or it does it makes one more spring. You see, which is nothing more than the scenario over here, the initial spring getting sprung again. So what does this mean? It means that really you only have these 3 models. These 3 models can describe all pullback behavior. Again, these 3 models can describe all pullback behavior. Because these 3 models, you either have 1 leg or you have more than 1 leg. If you have more than 1 leg, the low makes either a lower low or a higher low. And if you have another 3 legs or 4 legs or 5 legs, it's always the case. Either a lower low or a higher low. It's a binary outcome. So once you understand this, you'll see pullbacks and know exactly what to do and be very comfortable with them and know what to expect as well. All right, so this is a very, very important thing. Weiss doesn't go into this as much. He says basically that trading ranges resolve based on 3 conditions. The first is time manipulation, where just exhausted amount of time, long elongated range. The second is the spring, and the third is the apex. I'm taking a step further by saying there's just 3. One is when you have 1 leg pullback, and the other is when you have more than 1 leg pullback, and that scenario has 2 sub-scenarios, one of which is a spring, where the low makes a lower low than the prior low, or an apex, where the low makes a higher low than the prior leg. And everything else is a variant of the same thing. This is what I'm trying to explain to you, and if you understand this, you know exactly what to expect. If you know what to expect, you can take advantage of it and prepare and plan for it. If you're just going to look at pullbacks and not know what to do, you can't execute, right? Can't really take advantage of the opportunity. You have to know what to expect in order to plan for it, and when it occurs, execute the plan. Anyway, I'm done. Now let's go to his spring. Where am I? All right. When I speak at workshops, I say you can make a living by trading springs and upthrusts. Once you become attuned to the behavior of spring, your eyes will be open to an action signal that works in all time periods. Again, as you can see, he said signal. So this is why the spring is important as Wyckoff trader, or you got to know this. All right, and this is one of your key signals or setups. So, and the best thing is when this type of signal, right? If you're automatically planning for it when you're looking for it, because you're drawing the lines and you know what to expect and where to expect it, and you can even put an alert. So it makes trading a lot easier than what a lot of folks are doing, which is driving them up the wall, which is try to read every bar, which never works. or trying to read the order flow throughout the entire session, which is exhaustive and has too much noise, or a lot of other approaches. This is nothing more than finding a high and a low, putting a line when price goes to the line, alert, look at it, what's going on, did it spring, yes or no, on the spring, what happened, heavy buying on the spring, I'm looking for longs. Simple as that. And what do you know? Springs are one of the ways that the trading range resolves itself. So chances are, if there's heavy buying on that spring, as it comes back above the low of the prior, back within that range, there's a chance it's going to bust and go to a higher high, make a rally high, or get retested. So you have very good risk reward. Why? Because spring is the ultimate danger point, meaning it cracks below that low, and that's the lowest you can go on a range. It's not a double bottom, it's actually a spring. The lowest, the danger point on a range, the danger point on any price range is not that double bottom low. It's actually a slight penetration of it, springing it and coming right back in. That is the ultimate danger point for the range to hold. Where am I? So you will become attuned to the behavior that works. That is an action signal that works. Open to an action signal that works. You want to know what works. There's a lot of shit out there. This, that, value, blah, blah, blah. But he's giving you an action signal that works. You're looking for something that works. Here you go. Right? And that doesn't mean just go fucking buy a spring. It means you have to, there's other things he's going to show. I hope he goes through it, or I'll show it later. And exactly what to do. Anyway, the spring can provide an impetus for short-term pop playable by day traders. You want to day trade, bow. Short-term pop playable or tradable by day traders. You want to be a day trader. Here you go. Here's an action signal. Here's an action signal that works in all time periods. Hello. Knock, knock, right? Or serve as a catalyst for long-term capital gains. Obviously, bigger ranges, This is a very nice way of trading, all right? For me, a spring is a washout or preparation of a trading range or support level that fails to fall through and leads to an upward reversal. Now, let's stop here. A spring is a washout or penetration. In Wyckoff course, it talks about a shakeout, right? So a shakeout, when he says here a washout, is similar. It's just, I don't know why he says washout, but a spring is actually a type of shakeout. Okay, so washout, shakeout, whatever. All right, the duration of the trading range does not need to meet a prescribed amount. My view comes from years of tracking intraday price movement, where 4 days bond data, for example, represents a lot of bars on a 5-minute chart. A washout of a support level or trading range consisting of 320 bars suddenly looks like a worthwhile trading situation. The word washout or shakeout is very important because a lot of traders look for exhaustion and a washout. But there's another thing that you need to know that is not really talked about enough, and that is, before markup you have accumulation. In my view, you can have accumulation in ranges where he's accumulating a position, but a quick accumulation is actually is a spring. This is a form of accumulation. Why? Because the stops are here. So if someone's going to sell, you can buy, which is the same thing that's done on a climax In a climax, it's a panic sell, right? Panic sell that gives good opportunities to buy. This is a stop sell that gives opportunity to buy. In one situation, you have panic selling. In another situation of a spring, you got stop selling, right? So you're long, they sell, stop sold, other side buys. What is the other side buying? It's accumulation. What comes after accumulation? Markup, also known as this rally up here. All right. So what do you say? All right. So think about it this way, like here you have a washout, right? That ends a trend. That ends a trend. The climax, as you know, ends a trend. So let me ask you, what do you think ends a range? Because there are ranges in here. There are ranges in here. Climax and trends. What ends a range for the market to then rally into a new range? What ends a range for the market to then enter a new range? Everything has a beginning and an end. A trend has a beginning and an end, and the end of it is the climax. But what about these ranges of price movement? What ends those and gives you entry into the next range? If climaxes terminate trends, then what terminates ranges? And the answer is the spring, because both of them have the same outcome, the same thing in common, which is accumulation. Climax, the smart money is accumulating while dumb money is panic selling. Spring, dumb money is selling via the stops while smart money is acquiring, and this is therefore a form of accumulation. And climax is also high volume, someone's taking the other side of that volume, it's accumulating. So the question here is, you want to get the move up, what do you need to look in the current price range so you can get in the rally? And one scenario for that is the spring. All right, I'm not saying it's the only one, because we know that apexes do it also. We also know there's sometimes crazy movement, but this is one good, easy setup. All right. For me, the spring is a washout, etc. My view comes from years of tracking intraday price movement with 4 days. All right, a washout of a support level or trading range consisting of 320 worthwhile situation. The potential gain by a spring on a 5-minute or monthly chart is the function of the underlying trend. Underlying trend meaning get the spring in an uptrend. Get the spring in an uptrend. Market volatility. Do not trade dull markets. You need volatility. You need ATR. Obviously get a good market. And point and figure preparation. You can't do nothing about this, all right? I'm not going to go into point and figure preparation at all right? First, when a market breaks below a well-defined support lines and fails to follow through, I consider it to be in a potential spring position. I'll explain this. Right, so the potential gain by the spring on a 5-minute or monthly chart is a function of those three things. Right, the two of them you can control if you don't have a point figure chart, and the one is the trend, and two is the volatility. You got to be careful of dull markets. All right. Now I'd like for him to explain this a little bit more, because just okay, these three factors, but what about them? What's high? What's good? What's bad? What's low? When should you not? But I don't see any of that here. All right. All right. So first, when a market breaks below a well-defined support line, okay, this is important. All right, and fails to follow through. So don't just put a spring on every little nook and cranny. right? And fails to follow through. Follow through is another important concept. I consider it to be a potential spring position. In other words, the lack of follow through that raises the possibility of upward reversal or spring. It does not guarantee a spring, as we will see the price volume behavior and the broader context surrounding the spring. All right. Situation helps determine its probability and significance. Probability is the key word of it working, and significance of it being a shakeout to go higher. Second springs in an uptrend have a higher percentage of success. This is the first factor that he talked about. He talked about, the trend, the volatility, and point and figure prep. Well, what about the trend? Well, you should have an uptrend. Look for springs in uptrend. All right, they have a higher percentage, meaning you have the probability on your side when you look for springs in uptrends. If a potential spring in a downtrend fails to develop, short sellers gain useful trading information. It means it's not a spring, it's a probe to go lower. That's the key info. So it's going to go lower. All right. Third, a market's volatility often dictates, here you go, here's the explanation of those three factors. Third, market volatility often dictates the size of a spring's upward reversal. This is important. All right, if you have good volatility, you get good risk reward. Little spring risk, big reward rally. Trying to get the rally. So you want good volatility. You don't want to trade a market, let's say they're trading a market, but the damn thing has very low ATR. There's no point. Absolutely no point. You might as well just trade highs and lows instead of like trends. All right, the amount of preparation inside of trading range can also determine the magnitude of upward generated by the spring. While Wyckoff did not write about springs, he discussed how market tests and retests support levels. And we know that spring is the ultimate test. These tests give large operators an important gauge on how much demand exists around well-defined support levels. An engineered sell below such a level of support provides the ultimate test. If the breakdown fails to produce an onslaught of new selling, the large operator recognizes the supply vacuum and buys aggressively, thus producing fast reversal actions. Declines below support levels are often aided by stop loss selling. Some stop loss selling offsets long positions, while another portion may be new shorts entering the market. Market moves in reaction to bear earning report. When prices fall below a support level, I visualize a boxing match. If a boxer knocks his opponent out of the ring into the fifth row of seats, the opponent should not recover and return to the ring, slugging away with renewed vigor. The breakdown tilts in favor of the sellers. They're supposed to capitalize on their advantage. When this fails to occur, one can go long with a stop below the low of the break. What's he saying here? The boxer analogy is just, plow. He knocks, the boxer knocks the other boxer out of the ring, is out of the range, out of the support level, below the support level. But the boxer who just got punched, if he can come back with renewed vigor, then chances are it's a spring. So his boxing analogy is just referring to price going below a support level, just like a boxer gets hit and goes outside the ring. And if it comes back, then he's saying he's going to put a stop right below the spring. So this is execution. Go long with a stop below the low of the break. Now, I would say something else. I would say go into the lower time frames, and that will tell you if how strong that boxer is coming back into the ring, or how strong price is coming back into the range above that support level that it just penetrated. So that's what you need to do. This is buying at the danger point where risk is smallest. Why is it smallest? Because it's a spring. It's the best place in terms of risk reward, and the ultimate test. When this fails to occur, one can go long with stops below the low of the break and buying at the danger point where the risk is smallest. There you go. However, it does not mean we automatically buy every breakdown in hope of a reversal. We do not stand in front of a train. Since the decline below the trading range takes the possibility of a spring, you may wonder what size sell-off fits the definition of a spring. Unfortunately, no rules exist, but guidelines can help. A relatively small penetration gives the right look. Again, a small penetration gives the right look. Such terminology does not convey much meaning. The meaning comes from experience as, all right. He's just saying that when it springs, it should have no follow through. That's all I mean. He goes down, up, down, very little because of the lack of follow through, and reverses back up strong with a stop below the spring. Now he's giving this example and said, look at this. Does this look like a spring? Does this look like a small penetration of support? Does this look like, all of that? No. This is a different type of spring, but I wouldn't trade this. All right. If we consider only the size of the break, we would rule out a spring, even though the stock recovered and closed above the low, the support. At the low, all right, the stock had depreciated 14%. The magnitude of sell-off, much greater weakness. Basically, it's not a spring. Why? Too big, too much volume, too fucked up. All right? Don't buy. Too much risk. Let's go back here. All right, 6. Okay, a few weeks later, they stabilized and developed. The spring began on May 22nd. Look at May 22nd. Do you see the low? How much did the low go down? It didn't. It's a little penetration of the support line. Now, I don't like the red bar after that, but I noticed that it's immediately followed by a green bar after that. So this is different. This is more of a complicated spring and not just a one bar spring. It's a 1, 2, 3, 4, 5 entire range here, and then a break up. But I mean, the point here is that it's not a big red bar. Even though this is a red bar, there's a green bar right after it. Okay. here, the force of the buying overcame the force of the selling right here. Here's a nice upthrust right here. This is a good upthrust. Here, the jump above the previous day high removed any doubt it was a spring. Here you see there's a spring coming right back in the range. Spring coming back right back into the range. This is a dangerous upthrust, but you can see it goes up and it goes right back down, taking out the low. Taking out the low, close below the low, close above the high. All right? Here's another point. Most spring cause fast, profitable trades. That's what you need. All right? Fast, profitable trades. Without triggering bigger moves, they give action signals for 1 to 10 day swings. Wow. This point is about effort reward on the spring. Basically, if you have a small penetration with a small bar with a large volume, it means someone bought up all the selling. Basically bag holding and bought everything as other stops were being run. Someone else bought it all. So this is just a effort reward, a point about effort reward. All right. All right, so just a couple of things. Yeah, just a couple of things. When the market is in a spring position, right? You got a range, ding, ding. Look for the high of that bar to be taken out. All right, when the high gets taken out, especially by the open or whatever, that's a very good sign. So it springs, and then the market, the bar closes or opens above the high. The high of the spring bar needs to be taken out. That's what you're looking for. He's basically giving, I don't know what he's giving. He's saying that, okay, the high of the spring bar going back into the range. That's what his point is. It could also be the open. Like on the next day, if the open is back within the range, it's good. So what are we gonna look for is, it has to go back in the range. Back in the range, taking out the high of the spring. So there's a difference between a spring position and a spring. A spring position could just be a lower low. Okay, so what do I do? So you could have this here is a spring position. All right. It has penetrated the low. What does it mean? It doesn't mean shit. It means it's a spring position. It could also be a low low. We don't know. So what are we looking for? We are looking for the market to go back in the range. Back in the range means above the support level that was broken by the spring. And two, price to take out the high of the spring. You gotta take out the high. Has to make that the high. It has to take it out, meaning make a higher high. Higher high into the range. All right, so these are the conditions to look for. Where's the stop? Obviously, then when you get in, it's below the spring. All right. So the question is, why didn't he take this bar? What bar is that? Why didn't he take this bar, this big bar, right? Because it closes or takes out the high of the prior bar, the spring bar. The reason is it's not within the range. It didn't pull back into the range yet. It's only after this bar that price is closing above the highs and it takes out or whatever and comes back within the range. So those two conditions. Has to come back within the range, has to take out the high of the spring. And by take out the high, if it opens or closes above the high. The hell is this? Pardon the noise. Many trades occur around the edge of trading ranges. So there's no shortage of trades. It's very important because a lot of folks are looking for action. So, they don't want to sit down forever. So, you have a lot of trades. So that's a very good, important thing. You're just talking about other stuff like springboard and all of that has to do with the spring. And here it talks about shortening of the thrust. Um, and here's just two examples. If you have a spring on heavy volume and little range or little thrust, it means effort reward. If you have a spring on low volume and small bar, that means that it's weak. Selling is weak. So these are just two interpretations of springs. And here is the key. The main idea behind the notion of spring, upthrust, and shortening of thrust is the lack of follow through. I can't tell you how important this is because this is what a fake out is. A fake out is a wannabe breakout without follow through, which is your spring or upthrust. And in the situation of a trend, in the context of the trend, weak follow through would create a shortening of the thrust. It goes to the heart of the matter. All right, that's it. Without getting into like the volume and this and the range and overcomplicating it, this is the first and foremost. Did the spring have follow through? Yes or no? Did it come back within the range? Yes or no? How did it come back within the range? Is the trend up or down? Is it a spring in an uptrend? And look at what he's looking here. The narrowing of the price spread, which is the range, low volume, and position of the close indicated the selling pressure was spent. And here's another thing. The shortening of the downward thrust in an oversold position. Oversold position, he means it's touching the bottom of the channel. Overbought and oversold are nothing more than the trend channel lines. Overbought is the top and oversold is the bottom channel line, trend channel line. That's a good one right here. You see how it penetrated and come right back within the range with that bar? This is a nice spring. You see how again here it penetrated, came back within the range, taking out the high bar, the high of the spring. Again here, takes out the high of the spring. The rest is like going into the whole story and all of that. I just want to point out again and again, the key is there's no follow through. So it hits a spring, it tries to break the low, and there's no follow through, and it bobs right back up within the range and takes out the high of the spring bar. Once it does that, and it's doing that aggressively, it's a spring. Oh my gosh, he's going to go into more and more studies. So let's just take a look at this, and see where the upthrusts are. You see this, thrusted, came back within the range. It didn't have much follow through, came back within the range. If you're still not sure, look at the pullback and then get in on the retest. This spring is too deep. I can't really call this a spring. When it does that, it's a problem, like too much. You want small penetration. This is a good one right here. This is a good upthrust. This looks like a lower low and that looks like a higher high. So I don't like the way they look. And I would stay away from them until the entire wave is completed. If the entire wave is completed and it breaks the low, look like a breakout, then chances are, yeah, this was an upthrust, and you can just get in on the retest of it. So when you're not sure, just wait, and if it rallies favorably, you can just get in on the pullback. You see? So there's no need to buy the spring as it's springing, upthrust as it's upthrusting. Even if you don't get an immediate test, you'll get a rally from it and a pullback opportunity, right? So this is the upthrust. This is a very nice upthrust, right? Here's upthrust, this upthrust. Here the low is being sprung. This is what you want to see. You see, very clean. No follow through at all. Light penetration, immediate reversal. Go to low time frames, look for an entry. When it has this much thrust, like here, this I don't like. I wouldn't go long. Would you go long here? Fuck no. You know? So, yeah, I just stay back. There's spring, boom. That's the high low. Remember, you're drawing a range, looking for highs and lows, spring, boom. Look at the important point I want to make here. Look at the length of the range, right? Enough preparation is there. And look at the spring within that range, and look at what's happening after the spring. A rally is occurring. So wash out, go and mark up into the new range, right? So over here, spring, and go into the new range. Washed out the stops, going into new range. Wash out the stops, go into the new range. Now, that's a nice spring. Actually, this is spring too. So I began this chapter by saying how one can make a living trading springs and upthrusts. All right, springs and upthrusts are not as prevalent as double tops and bottoms. I probably disagree with that. I think double tops and double bottoms reaching the precise price level, meaning an exact double bottom or double top, is less than the number of springs. Because imagine you have a price, let's say 76.26, and then it gets retested exactly at 76.26. No, it's going to either be a little higher or a little lower. So what do you do when you don't have springs and up thrust? What do you do? Just buy, test the breakout. Done. Ooh, look at that. High, low, high, up thrust, boom. This is actually a low here. That's a spring of that low. I know of no better trading strategy than the spring. It produces short-term intraday trades and long-term trades. When that breakout occurs, that fake out occurs, traders back off, right? But the professional trader knows better. He watches for hesitation or little follow through, and quickly takes advantage of the situation. And it will earn nice yearly income. All right, so there you go. There's the spring, long opportunity. So, I mean, if you're following this style of trading, what do you want to do? Draw the lines, look for springs, look for lack of follow through and immediate reversal. Go to the lower time frame, make sure that reversal that takes out the high of the spring bar and goes back within the range is on heavy buying, and that'll help validate the spring, and you can enter it. So this is a wonderful way of trading. And also note that the purpose of that spring is a washout, or he says washout or shakeout. And one of the things that it does, if you're washing out, people are getting out, that means it's ending. What is it ending? Right? It's ending positions and taking them out, and it's initiating longs on the side of the CM. Meaning one side is getting out because of stop run, the other side is getting in because of stop run, and it allows for a move up that's very worth your while. So here you go. It's the best strategy he knows. There you go. All right, I'm done. Let's see what the next. Oh gosh, is basically the spring in the opposite direction. So we'll get into up thrusts in a bit. Take care. Next time. Bye.